The labor market's new math in the July 26 employment report delivered a message that commercial real estate investors and business owners and borrowers should not ignore. The U.S. labor market is slowing, but the numbers may require a different interpretation than they did just a few years ago. And non-farm payrolls declined by 23,000 jobs in July, compared with expectations for roughly the 80 to 85 thousand jobs. And even more significant, May and June employment gains were revised downwards by a combination of 103,000 jobs. And at first glance, those numbers look decidedly negative, but underneath the headline is an important structural shift in the U.S. workforce, one that could influence economic growth and Federal Reserve policy, and interest rates and consumer spending, and ultimately commercial real estate. A labor market losing momentum. And July's employment weakness was not isolated to a single industry. And government employment declined substantially, particularly in local education. Retail and leisure and hospitality also recorded meaningful losses, whereas healthcare remained one of the comparatively stronger areas of the economy. And the combination of weak July hiring and significant downward revisions to previous months suggests that businesses have become increasingly cautious about expanding payrolls. But that's only part of the story. So why did unemployment fall? Despite the decline in payroll employment, the unemployment rate actually moved down to 4.1%. And normally, falling employment would be interpreted as a sign of economic strength. This time, however, labor force dynamics played an important role, and the labor force participation rate fell to 61% as people continued to leave the workforce. And that creates an unusual economic equation. Fewer people actually looking for work can allow unemployment to remain relatively low, even when employers aren't creating many jobs. And demographics are increasingly important, and baby boomers continue moving into retirement, while reduced immigration has also constrained labor force growth. So for investors and business owners, this means that the headline unemployment rate may not tell the entire story. So let's talk about the labor market's new math. And a shrinking workforce changes the number of jobs the economy needs to generate each month. And historically, investors became accustomed to seeing payroll growth well above 100,000 jobs as an indication of a healthy economy. And that benchmark may no longer apply in the same way. So when labor force growth slows, the economy requires fewer new jobs to keep employment stable or unemployment stable. Consequently, an occasional negative payroll number does not automatically mean the economy is going into a severe recession either. So instead, investors need to evaluate employment along labor force participation and wage growth and layoffs and job openings and consumer spending, but also inflation. So welcome to the low hire, low fire economy. And perhaps the best description of today's labor market is low hire, low fire. And businesses appear reluctantly to expand payrolls aggressively, but they're not engaging in widespread layoffs either. And recent employment indicators continue to show relatively restrained layoffs, even as hiring momentum weakens. And that creates an unusual environment. And employees may be reluctant to leave existing positions because finding a new opportunity is just becoming more difficult. And employers, meanwhile, may retain experienced workers because replacing them could later prove to be very difficult. And the result is less labor market churn. And for commercial real estate investors, this distinction matters enormously. And there's a major difference between an economy that's experiencing slower hiring and an economy experiencing widespread job destruction. The first can produce slower growth, and the second can create significant pressure on occupancy and rents and credit quality and consumer spending, but also property values. So wage growth is becoming the next big story. And another important signal is wages. Average hourly earnings growth slowed to approximately 3% year over year. And that's the weakest pace since 2021. Meanwhile, recent inflation has been running above wage growth, which means it's putting pressure on the real household purchasing power of those wages. And that relationship deserves close attention. If prices rise faster than wages do, consumers effectively become poorer in real terms, even if their nominal paycheck does increase. So eventually, that can affect discretionary spending. And consumer spending matters enormously to commercial real estate. So think in your retail centers, in your restaurants, in entertainment properties, in hotels, and self-storage facilities. But also apartments and numerous other property sectors are all directly or indirectly linked to household financial health. So the Federal Reserve has a complicated decision, and normally weakening employment and slower wage growth would strengthen the argument for easier monetary policy. But the Federal Reserve faces a more complicated problem, and inflation remains an important constraint. And if supply disruptions within energy prices and through tariffs or geopolitical events or other factors keep inflation elevated, policymakers may have limited flexibility to respond aggressively to a weakening labor market. And that creates competing economic forces. And slower employment growth argues for lower rates. And persistent inflation argues for tighter monetary policy. So the Fed has to determine which risk presents the greater threat. And for commercial real estate borrowers waiting for dramatically lower interest rates, that means patience may still be necessary. So what does this mean for commercial real estate? And commercial real estate investors should watch several channels through which the labor market can affect property performance. So let's look at office. Slower white-collar hiring could reduce expansion demand and make tenants more conservative about their space commitments. And retail, weak real wage growth can pressure discretionary consumer spending and tenant sales. In industrial, slower economic activity can affect transportation and warehousing and inventories and distribution demand. And for multifamily, employment remains fundamental to household formation and rent growth and apartment affordability. And for hospitality, consumer confidence and employment and corporate travel and discretionary income can materially affect hotel performance. For owner-occupied CRE, business owners may delay expansions or acquisitions or equipment purchases or real estate investments when economic uncertainty rises. But there's another side to the equation. And if slower economic growth eventually allows monetary policy to become less restrictive, commercial real estate financing conditions could improve. And that could help transaction activity and refinancing economics and debt service coverage and property valuations. So what should CRE borrowers watch next? Well, one employment report does not establish a long-term trend. The next several employment, inflation, wage growth, consumer spending, and Federal Reserve reports will be especially important. And commercial real estate investors should pay particular attention to the interaction between employment growth, labor force participation, wage growth, but also inflation and consumer spending. And in turn, you'll see Treasury yields and the Federal Reserve policy and commercial mortgage rates come into play. And the critical question isn't simply whether employment is growing, it's whether household income and economic activity can remain resilient while inflation moves towards a level that gives policymakers greater flexibility. So the bottom line is that July's employment report does not necessarily signal an imminent employment collapse. It does, however, reinforce the idea that the U.S. economy has entered a different labor market environment. Fewer workers with slower hiring and weaker wage growth is our new economic equation. And for commercial real estate investors and business owners, the implications extend well beyond the monthly jobs headline. As employment influences consumer demand, and consumer demand influences businesses' performance, and business performance influences property cash flow, and economic growth and inflation ultimately influence the cost and the availability of capital. And that's why understanding the labor market isn't simply an economics exercise. It's part of a deeper understanding of commercial real estate risk. And that's it for the day. Thank you for watching. You can visit my website, billrapp.comloan.com. I appreciate your time and have a good day.